Gold is a super interesting commodity and it's also one of the most actively traded commodities on MCX. This is because you can even trade 1 gram of gold for which the margin requirement is just under 1000 rupees. In this video, I'll explain all the nitty-gritties involved in trading gold. So go grab your pen and paper, and by the end of this video, you should be in a position to get started with gold trading. Gold is an asset. It has its phases. Sometimes it's bullish, sometimes it's bearish, and there are times when it does nothing and the price moves sideways. And that's where short-term trading opportunities exist. You don't have to sit on gold for long-term for the returns to roll. You can actually benefit from these market shifts and trade gold actively. However, if you want to trade gold, you must understand that this is a leveraged product and there is considerable amount of risk involved. Of course, the underlying assumption here is that you know how to trade futures and options and all the risks involved. If you've traded equity derivatives, then understanding commodity derivatives is fairly straightforward. The concept of mark-to-market, lot size, contract value, margins are exactly the same. Before we dig deeper, let's quickly check all the gold contracts available to you on MCX. Essentially, there are 4 contracts. The main contract is called just gold. Then we have gold mini. Then we have gold guinea. And then we have the gold petal. Here is how the gold contracts differ from one another. Please note that the contract specifications may change from time to time. It doesn't really matter. What you really need to understand is the technique of reading these contracts. Let me help you understand these contracts. I guess I'll talk about the big gold contract first. The price of gold you see on your ticker is quoted for 10 grams of gold. The lot size of gold contract is 1 kg. So at the time of recording this video, the price of 10 grams of gold was 87,722. Therefore, the contract value of 1 kg of gold is about 88 lakhs. It is important for you to note that the price of gold on MCX is inclusive of all the import duty and taxes. The margin across all the 4 gold contracts is fixed at 8.25%. Of course, this can also change from time to time. Given that the contract value is 88 lakhs, the margin required to trade the main gold contract is roughly about 7.25 lakhs. The smallest price move in this contract, also called the tick price, translates to rupees 100 per tick. To put this in perspective, assume you are long on gold and gold moves by 1%. Now this 1% move in gold translates to about 877.22 points. Now each point is rupees 100. So in this case, you make a profit of 87,722 rupees for every 1% of up move in gold. Of course, this is a very large move for any retail trader. Hence, there are smaller gold contracts that you can trade on, such as the gold mini, gold guinea, and the gold petal. The contract sizes for these is roughly about 8.7 lakhs, 70,000 and as small as 8,700 rupees. Let us just double click on gold petal for a second. The lot size for gold petal is just 1 gram, which makes the contract value just about 8,700. And at a margin requirement of 8.25%, you only need about 750 rupees to take a position in gold petal. Now here is something interesting. Now because gold is available in 4 different formats, you can actually get a margin benefit when you go long in one contract and short in another. Here is an example. Of course, you can deploy all the standard spread strategies such as the ratio spread or the calendar spread while trading gold. Please note, brokers permit you to trade commodities using a single ledger, meaning you don't have to transfer money separately to trade commodities. The regular fund transfer that you make to your trading account can be used to trade both equity and commodities. This is a big advantage for commodity traders as it saves a lot of time. Gold as a commodity is physically settled, meaning if you hold a gold contract up until expiry, then you are expected to take delivery of this. But some brokers, including us, do not facilitate physical settlement of gold. You are required to close your position in gold 1 day prior to the tender period. The tender period is when you hold the position with an intention to take delivery of commodity. So if gold March contract expires on April 4th, the tender period starts 5 days before the expiry, which is 22nd March. However, if your broker does not permit physical delivery, you will have to close your position 1 day before delivery, which is 21st March. Now here is another important thing. The liquidity in the current month contract starts to dry up as it approaches the tender period. Trading activity picks up in the next month's contract. So if you intend to trade gold near the expiry date, make sure you figure when is the tender period and choose your contracts accordingly. Another point to note, commodity markets in India opens at 9 am and closes at 11:30 pm. However, based on the US daylight savings, the closing can also shift to 11:55 pm. So if you're trading gold or any commodity, pay particular attention to what time the market closes. There are option contracts on gold, but as of today, these contracts are restricted to gold and gold mini. In the money gold contracts, upon expiry, devolves into gold futures. Of course, you can do the usual option chain analysis on gold as well. Hopefully, this helped you understand all the specifications of gold contracts. With this out of the way, let's focus on what really moves gold. The first thing to pay attention to is the relationship between gold and the US dollar. Internationally, gold is priced in US dollars. Gold and USD share an inverse relationship, meaning if US dollar starts to strengthen against a basket of currencies, then the value of gold decreases and becomes less attractive. On the other hand, if US dollar starts to weaken, then the value of gold tends to increase. In fact, this is true for all commodities whose prices are denominated in US dollars. Let's try to understand this relationship keeping Indian markets in perspective. Gold price in US is quoted for 1 ounce. 1 ounce is roughly about 28.3 grams. I'll simplify the math here just to explain the relationship between gold price, US dollar and Indian rupee. Today, as of recording this video, 1 ounce of gold is traded at 3,000 US dollars. As I mentioned earlier, 1 ounce is roughly about 28.3 grams. So the dollar price for 10 grams of gold is about $1,060. USD to INR is about 86 rupees. So the price of 10 grams of gold in INR is $1,680 into 86, which is roughly about 91,000 rupees. If US dollar strengthens, that means rupee and other basket of currencies weakens. Assume for a moment that US dollar goes to 100 rupees. Then the price of gold per 10 grams goes to 1,600,000 rupees. This increased price of gold makes it less attractive for domestic institutions, central banks and of course the traders. This lowers the demand for gold. So as a trader in gold, look for the factors that influence US dollars and treat those factors as a leading indicator to base your trading decision on. But having said all this, there have been instances in the past where this relationship has not held true. For example, in 2016, oil prices crashed from $110 per barrel to $30 a barrel. This created havoc in oil-producing countries such as Saudi Arabia. Investors there rushed to move their assets from oil to safer havens like US dollar and gold, which led to a rally in both US dollar and gold. This is something you need to keep an eye on. Besides the US dollar, also pay attention to the US Fed. The logic is simple. If Fed increases interest rates, then the US bonds and other fixed income products become more attractive than gold, and money flows out from gold and follows into bonds. But having said this, it is also very important for you to understand that this correlation has not held true in the recent past. For instance, the Fed started a rate hike cycle in March 2022 just after Russia's invasion of Ukraine. The war situation had threatened global stability. However, while the interest rates were high, gold prices also surged. So here is my advice. Besides the US Fed rate, pay attention to US inflation numbers and US job market data. These are all good to know information that helps you in your decision making process, but do not depend on them entirely. While all these things matter on one side, what equally matters is the demand-supply situation in gold. On the supply side, there aren't many triggers. Finding new gold mines, extracting gold, and estimating how much gold can be mined takes decades of effort. Plus, I think the world is in a better position today to accurately estimate the quantum of gold available on Earth. It's the demand side where things are more volatile. Any event that disrupts the world order tends to increase gold prices. This is because gold is perceived as a safe haven. Almost all the major events in the past has impacted the price of gold. Think about it. The oil crisis, the Middle Eastern uprising, Israel-Palestine issue, European migrant crisis, Greek economy, Euro crisis, Lehman Brothers, Russia-Ukraine war, Gaza issue, the list is never ending. The point to note here is that any geopolitical issue tends to increase the prices of gold. One common query: these are some of the things that you should pay attention to when analyzing gold fundamentally. Technically, you can apply all the principles of technical analysis on gold as well. Standard technical practices such as candlestick patterns, support and resistance levels, trend lines, indicators, etc. can be applied on gold as well. Lastly, before I end this video, let's quickly talk about silver. Silver has three contract variants: Silver, Silver Mini, and Silver Micro. The price is quoted for 1 kg of silver. The margins to trade silver futures varies from 5.2 lakh for the main contract to about 17k for Silver Micro. There are no option contracts on silver as of today. Your thought process to trade silver should be exactly like that of gold. You do not need any separate trading technique for silver. Most traders end up using the same trading techniques for silver as that of gold. In fact, check this correlation data. The correlation between gold and silver is as high as 0.88. I hope you found this video useful. If there is any particular trading strategy around gold and silver that you want me to talk about, then do drop a comment below. Happy trading!